Welcome to our reading on employee compensation, post-employment and share-based. Now, of course, post-employment just really means, in particular, pension accounting. Pension accounting is one of the topics that probably ranks as one of the hardest conceptually to understand in all of the CFA syllabus, and I'm talking about levels 1, 2 and 3 here. Certainly causes students a lot of conceptual difficulties, so expect this one to be a little bit of a battle. Now, our first little learning outcome asks us to describe types and implications of pension plans. So let's start by having a quick look at a definition. So a pension plan is an agreement under which an employer agrees to pay monetary benefits to employees on their retirement from active service. Okay, so it's payments going from the employer to the employees when they finish working. Employee benefits are based on predetermined factors such as average or final compensation, years of service and age. Well, what we've really just defined with these two quotes are defined benefit pension plans. And we're going to see on the next couple of slides there are two major types, defined contribution and defined benefit. Defined contribution is going to cause us and you no problems at all. Defined benefit, however, is going to be turning your hair grey overnight. Okay, so here are our two major types of plan, defined benefit, defined contribution. We just need to be able to distinguish between them. With a defined benefit plan, of course, the employer is agreeing to make payments to you based on those predetermined factors such as the number of years you've worked and, of course, your final salary. So the employer has all of the risk of ensuring that they have a pool of assets sufficient to generate those cash flows. Now, because essentially the employer has the risk of making the payments to you, the employer also owns the assets that the fund invests in during the employee's working life. And of course, typically your employer will appoint an investment manager to run the fund on their behalf. And of course, the employer makes periodic contributions to the pension trust in order to fund the pension plan. So with a defined benefit pension plan, we're going to have a liability that's going to represent the amount owed to the employee once they retire, and we're also going to have an asset being the pool of assets used to fund that liability. Now, defined contribution pensions are much simpler. Essentially, all your employer is doing here is guaranteeing to pay a fixed percentage normally of your salary into a plan for each year that you work. Now, what that plan or what that pool of assets will actually pay for when you retire, what kind of annuity you'll be able to purchase, that's your problem as an employee. So the employee therefore carries all the investment risk here. The employee is the actual legal owner of the assets, and the employer is simply acting as an agent, making that promise to pay in fixed percentages of your salary for each year that you work. The employee therefore gets to direct the investment policy, and we don't have pre-funding on these. Remember, this idea of pre-funding is the idea that you've got a liability and you use a pool of assets to fund it. But in this situation, the employer doesn't have a liability and therefore doesn't need a pool of assets to fund it. So pre-funding is not applicable. Right, well, let's have a look at defined contribution accounting, and we can really sum it up all in one slide, and which means the rest of this reading is going to be looking at defined benefit. Okay, now the LOS asks us for the implications for financial reporting, and the basic idea here with defined contribution is there are no significant implications. Now remember, all they're doing with defined contribution is agreeing to pay a fixed percentage of your salary into a fund each period. So they are not promising a specific level of retirement benefits when you retire. So the accounting is dead straightforward. In the income statement, all we'll have is the employer's contribution. In the balance sheet, potentially we could have an asset or liability, but often we'll see nothing. Potentially we could have a liability to the company if they were due to make a payment into your plan but hadn't done it at the year end. I guess theoretically you could have an asset if they'd overpaid into your fund for a specific year. But the basic rules here is the analyst has absolutely no issue with the accounting for this. So we're quite happy with the way it's all been accounted for, and as a result, that's the end of defined contribution accounting. So let's turn our attention to defined benefit accounting. And as we've said, this is the one that's going to cause us the trouble. Two types of plans: non-pay related plans, when the benefits you receive on retirement are not linked to your salary level, and the other type of pay related plans where, of course, the benefits that you receive on retirement are linked to your salary level, and it's normally your final salary they're linked to. Now, the type of defined benefit plans that we're going to be looking at here are generally pay related plans. So remember, the employer here is bearing the investment risk because they're guaranteeing to make fixed payments to you based on how long you've worked for the company, what your final salary is likely to be, etc. So they are promising specific amounts to you on retirement, therefore they have a liability. Now, of course, they need to estimate that liability, and they use firms of actuaries to do this. And why do they need to estimate the liability? So they can work out the required contributions into the plan assets to ensure that they've got a pool of assets sufficient to generate those cash flows to you when you retire. Now, the upshot is we're going to see some extremely complicated accounting treatment for defined benefit accounting, and worse than that, there's differences between IFRS and US GAAP. Okay, we're asked to explain and calculate pension liability measures in this learning outcome. Under US GAAP, our major liability measure is called the PBO, the Projected Benefit Obligation. Notice that under IFRS, they have an exactly same liability, so the same kind of concept behind it, it just gets a different name. Rather than calling it the PBO under IFRS, we're going to call it the PVDBO, the present value of the defined benefit obligation. Okay, note in the readings, in the Institute's material, in the Swayzer material, and in these slides, we're going to just use PBO and PVDBO interchangeably. So we'll often use PBO just because it's a little shorter, even when talking about IFRS, but it is the same thing. So that leads us to say, what is the projected benefit obligation? Well, it's a present value figure. What we're going to do is estimate the pension payments based on your current service history, but based on your final salary. So it's based on your working record to date, but the payments are based on your expected final salary, and we're therefore assuming that you are going to work until retirement. Now, what we've therefore done is worked out the payments to you on retirement based on those two factors, current working history and your final salary, and what we've then got to do is discount them back from the future all the way back to today's date. So it's the present value of those future payments. So think of the PBO therefore as simply the present value of the payments made or that are going to be made to the employee based on the employee's current working history and final salary. That's why we call it a liability on a going concern basis. Because, of course, if we were to terminate the pension plan, if it was to be shut down today, your current salary would be your final salary. Okay, and as a result, that would give us a liquidity basis. So because it's based on your final salary, that's why we're assuming that the company will continue and you will continue to work up until retirement age. Okay, let's just talk slightly about the differences between IFRS and US GAAP, in particular what we see in the financial statements. Now both of them, both IFRS and US GAAP, have this idea of looking at the net of the liability side and the plan assets, and both of them actually really refer to it as funded status. So let's start with IFRS. So what we're going to look at is the net of the present value of the defined benefit obligation and the fair value of plan assets. Remember, PVDBO, think of that as the liability side, plan assets, clearly the asset side. So overall, the funded status of the pension plan is essentially the net of the two. Now, IFRS doesn't leave it there, so we do not see funded status on the face of the balance sheet under IFRS. Instead, essentially, we're going to see a lot of smoothing adjustments. And you can see we're saying adjustments here are made for deferred gains and losses and past service costs. We're going to see some kind of smoothing going on. Just be a little bit careful with that past service cost. It's actually only unvested past service costs, but we'll talk more about that later. So don't worry quite at the moment what these deferred gains and losses are. We're going to explain them in much more detail later on in this reading. All I really want you to take away from this slide is under IFRS, the balance sheet asset or liability does not equal funded status. And notice we've said this is very similar to old US GAAP rules. Under old US GAAP, pretty much it was consistent with IFRS. Now, US GAAP has recently changed a few years ago. Now, the key difference is the balance sheet asset liability under US GAAP does equal funded status, so they don't make the smoothing adjustments. What we're going to actually see under US GAAP is they do everything, all the accounting exactly the same as IFRS. They get to the end of that and say, oh, our asset or liability doesn't equal funded status. They then force the asset or liability to funded status. So, if you remember, we're asked to explain and compute the PBO, so we better know the PBO components. Service cost. The service cost is simply the change in the PBO because your employees have worked for one extra year. So the service cost, therefore, is the increase in the PBO due to employees' efforts based on their final salaries. For every year that they work, they're entitled to more when they retire. Interest cost. Now, the interest cost, if you were to hold everything constant, the PBO would still increase from year to year. Remember, the PBO are the payments that are going to be made to the employee on retirement discounted back to today's date. As a result, for every year you work, you're 1 year closer to retirement, and as a result, those payments are being discounted back one less period, and as we know, if you discount back one less period, the present value's got to increase. So therefore, the interest cost is really just the increase in the PBO as a result of the passage of time. Note we can compute it by taking the PBO at the beginning of the period and multiplying by the discount rate that the actuaries used to discount those future benefits back to today's date. Actuarial gains and losses. These are changes in the liability, changes in the PBO as a result of the actuaries changing their assumptions. Now, what kind of assumptions do they use? Discount rate for one of them, to discount those future cash flows back to today's date. Change the discount rate, you change the PBO. So discount rate is key. Rate of final salary, of course, what your final salary is like to be. If they change their assumptions there, it will change the benefits that you'll receive. It will therefore change the PBO. So think discount rate, think final salary in terms of creating these actuarial gains and losses, and then any other adjustments that they make, things like your life expectancy, for example. Anything that affects those future benefits will be an actuarial gain or loss. Now, be aware that you're going to encounter other actuarial gains and losses, in particular on the asset side of the plan, caused by the difference between using actual return on plan assets and expected return on plan assets. That affects the asset side of the plan. It does not affect the PBO, so you will not see it in a PBO reconciliation. Here, we're just talking about the actuarial assumptions that directly affect our liability measure. Prior service costs you might also see affecting PBO. This is essentially when the employee changes the structure of the pension plan itself. So maybe I was going to pay you 60% of your final salary per annum on your retirement, and I've changed it to 65%. Of course, that extra 5% is going to increase the PBO, and we call it a prior service cost because it affects all of the payments that I'm entitled to from my existing working history. So of course, if I increase the payouts, then it's going to make my PBO bigger. If I was to reduce the payouts, of course, it will make the PBO smaller. We should be aware, as we're going to see a little later, that prior service costs have different treatments under IFRS and US GAAP, but you'll see them in the PBO reconciliation for both. Finally, benefits paid. Well, of course, given that the PBO is a liability, if we make payments to existing retirees, we are paying down some of our liability, so we expect the liability to reduce by the benefits paid. Let's put that all into the reconciliation that we see in the footnotes of a set of accounts. So this is the reconciliation that you'd expect to see in the footnotes of accounts. Starting with last year's PBO, the beginning PBO, they add on the service cost, add on the interest cost. They would then deduct actuarial gains and add actuarial losses Remember, these are changes in the size of the PBO caused by your actuaries changing their assumptions on things like discount rate, things like rate of final salary increase. Okay, if it's an actuarial gain, it's reduced the PBO, so we subtract it. If it's an actuarial loss, it's increased the PBO, so we add it. Notice we're saying only the actuarial assumptions that would directly affect the PBO, the liability measure. So they've got to either affect the discounting process of those payments or the payments to the retirees themselves. Prior service cost, remember, is a change in the PBO as a result of a change in the terms and conditions of the plan. Again, if it was to increase the PBO, it would of course be added. If it decreases the PBO, it would be subtracted. Then finally, of course, we reduce the PBO by the benefits paid to retirees during the year because, of course, essentially that is extinguishing some of our liability, and that gives us the ending PBO. Okay, and remember, you can think of PV-DBO and PBO as being the same thing. So this is true of US GAAP and IFRS. Well, we are asked to calculate the PBO, so we could do it via the reconciliation that we've seen on the previous slide, but we could also have a look at a kind of manual computation of PBO. So we've set up a little example here, very, very simple example. We've got a company with a retirement age of 65. Your pension entitlements, you're going to be entitled to 1 month's salary, expected salary, based on your final salary, times the number of years that you've worked. Okay, it's based on your final salary. Employees' benefits vest immediately. All that means is you're entitled to full benefits as soon as you start working. With some schemes, you need to work a number of years before you're entitled to pension benefits. Our actuaries believe our employee was likely to live for 15 years post-retirement, and they've chosen a discount rate equal to 10%. To keep it simple, our pension contains one employee. You can see we have Kevin Gallen here, who's got 26 years to retirement, so he's currently aged 39. Remember, he retires at 65. The actuaries believe that Kevin's final salary is going to be $36,000, and he started working at the beginning of this year. Okay, so therefore, at the end of the year, he's worked for 1 year, and as a result, he'll be entitled to 1/12 of his salary. So there you go, the retirement annuity. On retirement, he's entitled to 1/12 of $36,000 each year. So that $3,000 there is simply 36,000 divided by 12. Actuaries think he's going to receive that for 15 years, and therefore we can compute the present value at retirement. Okay, so to compute the present value at retirement, all we've done on our calculator is we've entered 3,000 as payment, N as 15, 10, remember the discount rate, as IY, and computed the present value in order to get 22,818. Now that is the present value of the payments to Kevin when he retires. Remember, the PBO is not the present value when you retire, it's the present value at the current point in time. Now Kevin, of course, has 25 years until retirement. Now on the previous slide, we said when he started to work, he had 26 years to retirement. Remember, we're now at the end of his first year's work, so he's only got 25 years until he retires. So what we need to do is take that 22,818 and discount it back for 25 years. So we're going to enter 22,818 as the future value. N is going to be 25, IY is going to be 10, and we're going to compute present value. And that gives us the present value today of 2,106, which of course is the PBO. Let's move on to year 2. Now of course, year 2, Kevin is now entitled to 2/12 of his final salary. So of course, if his 1/12 plus 3,000, 2/12 are going to be 6,000. So again, what we've now got to do is work out the present value of the annuity at the date of his retirement. In other words, enter 6,000 as payment, N as 15, and 10 as our discount rate, and compute present value to get 45,636. We've then got to take that 45,636 and discount it back to the current day. Now, of course, At the end of the first year, he had 25 years to retirement, so at the end of the second year, he's now only got 24 years to retirement. Okay, so to work out the PBO today, we need to enter the present value at retirement as our future value. So 45,636 is going into the calculator as the future value. Discount rate, IY, is 10, N is 24, and we're just going to compute PV to see a figure of 4,633, which is the PBO at the end of the second year. Now, what we're going to try and do here is reconcile between the PBO at the end of year 1 and the PBO at the end of year 2. So let's have a look. You can see we've done it by computing service cost and interest cost. We've got no payments to existing retirees because Kevin's the only employee and he's still working for us, and we haven't made any actuarial changes or prior service changes to keep this nice and simple and clean as an example. Okay, so let's work out this service cost. Where did this figure of 2,317 come? Remember what service cost is. It's the present value of benefits earned because Kevin has worked for 1 extra year. Well, what is he entitled to because he's worked for 1 extra year? Well, he's entitled to another 12th of his salary, an extra £3,000 per annum for 15 years. So let's take that extra that he's earned for working 1 extra year, $3,000, and essentially what we've got to do is compute the annuity and then discount it back for 24 years. So in our calculator, first of all, we need to enter 3,000 as payment, 10 as IY, N as 15, and compute present value. That gives us the future value of the service cost, if you like, or the value of the service cost on his retirement. Then we need to discount it back 24 years, of course, to the end of year 2. So, of course, to do that, we need to enter 22,818 as our future value, IY is 10, N is 24, compute PV, and you get 2317. Okay, so let me just recap that one because it does cause people trouble. Remember, he was entitled to an extra $3,000 because he worked for a second year, essentially giving him an annuity stream of $6,000 compared to an annuity stream of $3,000 in year 1. So his annuity stream increased by $3,000, and it's the present value of that increase that we're looking at when we look at service cost. Interest cost, very straightforward approach. All we need to do is take the opening PBO, the $2,106, and multiply by our discount rate, 10%. And you can see we've rounded it slightly to 211. Remember, what is our interest cost? It's the increase in the PBO due to the time value of money, the passage of time. Remember, if nothing else was touched on this pension, the PBO would get bigger essentially each year simply because you're discounting back one less period each period. Okay, so you can see therefore that we've reconciled year 1's PBO to year 2's PBO with a tiny rounding difference. Okay, let's turn our attention to thinking about the other side of the defined benefit plan. One side, of course, we've said is the liability, and we've now defined that as the PBO. The other side, of course, are the plan assets. And we need to know the components that go into this. The employer contributions, of course, are the contributions that the firm makes into the pension fund each period, and it's going to be a function of, you can see, taxes, it's going to be a function of pension rules and cash flow considerations, and it's also, of course, a function of the funded status of the pension. If you've got a severely underfunded pension, because the liabilities are much bigger than the assets, chances are the employer is going to have to increase their contributions. If you've got an overfunded pension because the assets are bigger than the liabilities, then they may take a break from contributing to the plan. So we have our employer contributions. We then have the return on assets. And it's very key that we should note that we're looking at the actual return. So we're looking at the actual capital gains, dividends, interest that we've made during the period, both realised and unrealised. So it's the total dollar return on the portfolio of assets. And clearly this is going to fluctuate as stock markets rise, stock markets fall. Our final element, you can see, are benefits paid to the existing retirees. Again, the logic essentially here is we're going to be liquidating the plan assets in order to make the payments to the existing retirees. So that, of course, benefits paid are going to reduce the plan assets. Let's have a look at how the reconciliation may appear in the footnotes. So you can see you've got the fair value of plan assets, the market value of plan assets at the start of the year. We're then going to add on any positive return on plan assets, the actual return. If we've got a negative return on plan assets, maybe because of stock market crashes, we're going to subtract it. Then add on the employer contributions in the period because they're increasing the assets. Finally, deduct the benefits paid to your existing retirees, and you should have the fair value of plan assets at the end of the year. We are just seeing the market value of plan assets. It is the market value of the assets that are going to be used to fund the liability. So let's revisit that idea of funded status. We are asked to be able to calculate funded status here. So to calculate funded status, all we need to do is compare the plan assets to PBO. And the easiest way to do that is to take the fair value of plan assets and subtract the PBO to get your funded status. Clearly, therefore, if the plan assets are greater than PBO, you're going to get a positive result. Your plan is overfunded. Whereas, of course, if the plan assets are less than the PBO, you're going to get a negative result, indicating your plan is underfunded. And we really like funded status as an analyst because we're going to argue that that is the true economic position of the plan. This is the real economic asset or liability. Now remember, with funded status, we do not see it on the face of the balance sheet under IFRS, but we are going to see it on the face of the balance sheet under US GAAP. Pension expense, the LOS here says describe components. No calculate LOS here, it's just describing the components. Now some of these we're already going to be familiar with. Notice the first two things we see are service cost and interest cost, often referred to as actual expenses. So remember our service cost, it's the same amount that we saw going through our PBO reconciliation. It's essentially the present value of the benefits that the employees have earned for working one extra year. Interest cost, again, the same amount that we saw in our PBO reconciliation. It's the increase in the PBO due to the passage of time. Then note that we deduct the expected return on plan assets. So this is part of our smoothing process here. Deducting the expected return on plan assets rather than the actual return on plan assets. Why? If we were to deduct the actual return on plan assets, then as the actual return fluctuates due to stock market volatility, our pension expense would fluctuate as well, giving us, in other words, a more volatile income statement. So what we're allowed to use is the actuary's long-run expected smooth return on plan assets. Okay, we then have some amortization of gains and losses. These are the amortization of actuarial gains and losses, deferred gains and losses. If we amortize an actuarial gain, it's going to reduce the pension expense. If we amortize an actuarial loss, it's going to increase it. We'll also see amortization